So why does he still see the Fed cutting several times this year? Barry Knapp is director of research at Ironside's Macroeconomics. Barry, do you put a lot of stock into how the market does day one?
Well, I think the most important thing going on from a market's perspective is the Treasury market, which rallied the last few days of the year. But I think that was solely a function of expensive financing over the turn to maintain shorts. There's no doubt that one of the highest conviction trades for the beginning of the year is Treasury yields going up, that this idea that we're struggling with debt management, we're struggling with debt and deficits. And so you got a little covering late in the year, but then people were able to reset shorts. And so I think more so than even this markdown of the Atlanta Fed GDP now, the real near-term risk for equity markets, and it was pretty evident late last year in the, in the performance of things like small caps and the equal-weighted S&P, is a further extension of the move higher in rates. We're 10-year tips to get to 2.5%, 10-year nominal rates to get approach 5%, back in that high that we made in OC of 23, then surely the equity market's going to struggle mightily and probably have a 10% pullback or so. So I think for me, that's the most important thing going on in the markets right now, is what's happening in the Treasury market.
So you think that higher rates are a headwind, even though, like you look back to the late 90s, right? The analogous period a lot of people are drawing between then and now. And you had long rates backing up significantly from like 95 or 96 to maybe 4.5% to 7%, roughly speaking, something like that. It wasn't a headwind. It almost seemed like a positive sign of kind of excess in the economy or something like that. I don't know. And by the way, what about the idea? What if rates don't go up this year? I mean, sure, we got about as good a data point as we could get on jobless claims, right? But you look into next year and you wonder, is the economic data going to continue to be able to surprise to the upside? The deficit numbers could end up coming in a little bit. I don't know.
Yeah, I think there's one of the big differences between the late 90s and now is that, Gingrich and Clinton went to war. They shut down the government in the end of 95, 96. And then we got the deficit on a much better trajectory. In fact, we ran surpluses late that decade. That's, I'm confident that Bessent, Moran, and Hassett are going to make progress on that debt issue, but they've been left just a real, very difficult situation with the excessive amount of bill issuance, the overhang of the Treasury or the Fed still owning $6.5 trillion of Treasuries. So there's just no easy way to work through this. And you may have seen on New Year's Eve, Dr. Slock put out one of his little daily notes saying, well, the term premiums moved up 75 basis points. I think for it to go to where it used to be, the median level pre-QE, it's got to go up another 75 basis points. So we have still some real serious headwinds in the Treasury market. On balance, Treasuries are still overvalued even at these levels. And they're not going up because of growth, Kel. They're going up because you could see this in the swap spread widening, this term premium going up. They're going up because of this, supply issue.